Good afternoon, everyone. Thank you so much for joining Stock Specialists' first webinar for 2023. I hope everyone had a pleasant New Year's break and everyone is back into it. But we're definitely back into it here at Stock Specialist. This is Marcos from the Portfolio Managers here, and I'm joined by my CEO, Mark. How are you, Mark? How was your break?
Good afternoon, members. It's a pleasure to be here. Pleasure to be back. Welcome to everyone now as part of the webinar. I thoroughly enjoy being part of the webinar series and look forward to continuing on.
Definitely, we love having you here. We're going to jump in to a few things here just across the start of 2023, but just a quick disclaimer beforehand. Of course, everything we say in this webinar is just general advice only. If you do require any personal financial advice, feel free to seek out your recommended broker or financial planners. So just jumping in, I'll run through the agenda for today. We're going to take a quick look as to what occurred in 2022. It was quite a tumultuous year. A lot of things going on, both in the macro sense, global supply chains, all this sort of good stuff that, of course, has a direct flow-on effect to the share markets and various sectors there. So we're taking a look at interest rates, where we're looking at possible inflection points, possible pivots in the monetary policy that various central banks will be looking to implement this year, and the possibility from where we're looking at recessionary pressures going into growth, and then, of course, how we can actually manage these shocks and what sectors we're diversifying into, and of course, what we're staying out of, which I think is equally important. So Mark, jump us through what's been happening.
Yeah, no, look, I mean, it was certainly a very volatile, it was certainly a volatile year with respect to geopolitical tensions, as well as also supply chain disruptions. You know, we started off there from about November kind of last year, you know, north of that 7,400 level. You know, we saw that war in Russia, Ukraine break out. We then saw markets correct there, you know, pretty significantly. They're losing about 500, 600 points worth of value. And then, you know, we had the rhetoric around rising interest rates, you know, which came to fruition. You know, the RBA, you know, just a few months before that was saying that they weren't necessarily going to be seeing out a rise in rates, you know, probably towards the end of the year of 22. You know, that rhetoric changed when we started to see inflation really start to come through, as inflation had been absent there for several years. Moving to about December there, 22, we ended up finishing the year there pretty much break even, still slightly down there, about 4.3%. There on volume, you know, which is kind of typical during the holiday season. It's important to note that while this period played out the way it did, investors, off the back of rising interest rates, you know, were looking thoroughly at their own portfolios and wondering, what sectors should I be rebalancing out of, and what sectors should I be then getting into? And these are some of the sectors and some of the stocks that we'll be talking about a little bit later on throughout the webinar. So 22, eventful year. The ASX 200 relatively well there in 22, only down about 5.5% there for the year, while the S&P 500 slumped nearly that 20%. You know, and look, there were a lot of doom and gloom pundits there throughout 22 saying, you know, the markets were going to get down to about that 6,000, maybe even, you know, 5,500. Some research houses out there. The Australian industry strength, off the back of a very low interest rate environment there for several years, really reflected through there, regardless of the rate of acceleration of interest rate rises there from essentially 0.1 to now around that 3.1% there on the cash rate. Now, we saw iron ore prices there, just on your chart, kind of slump off the back of Chinese restrictions there ahead of the Olympics. We saw COVID lockdowns. We saw the property market troubles. We then moved forward a little bit there to about December. We saw there the US inflation prices kicked in at the fastest pace since 1982, and inflation there and interest rate hike fears continued to escalate. Inflationary pressures there, as a side note, continue to remain at levels above where we would like them to be. This is going to have implications on asset pricing moving forward for the next 6 months, which we'll get into shortly, as well as also macroeconomic policies. At around there in March, we saw the first rate hike there by the Fed. We saw oil and commodity prices surge due to the Ukraine war. We also saw food prices surge, timber prices climb. We also saw the Chinese lockdowns there really come into effect. We had that property market debacle, which they're still sorting out, and they're looking at quantitative easing measures as well as also rate cuts to be able to kind of support their side of the economy there in China. The biggest issue, of course, there with China's transparency, but we can't get too much into that because nobody really truly knows the extent of what they're doing behind the curtains. They're further beyond what they're saying they are doing. So the RBA then here in Australia increased rates, first time there in 11.5 years. And members, investors, I want you to remain kind of cognizant of the fact that we were in a low interest rate environment there for 11.5 years. Certainly, we saw, especially across the private sector, business investment climbed significantly. Housing consumption increased considerably. Wealth, in terms of property valuations, saw Australians feeling richer than ever. We saw equity prices also continue to climb there. So, in terms of asset prices, our take is that we're still somewhat higher than where perhaps we would like to be, which we'll kind of touch on a little bit later on in this webinar. We'll talk about a few stocks there, as I previously mentioned. So let's jump onto the next slide now. We saw there in 22 inflation. Now, the biggest economic story there is inflation. It's also interest rates. Then what's going to follow on is going to be then corporate earnings. Now, we haven't really seen earnings move too much. However, the expectation for 23 is something that we will start to see kind of corporate earnings reflect higher interest rates, and therefore then business investment decisions start to also reflect that. If we look at the consequences of inflation and the Ukraine war there with Russia, we saw energy prices climb significantly. The biggest winners there of 22 for the calendar year 22 were oil, gas, and coal companies. Especially there on the coal side. Here in Australia, we saw Whitehaven Coal there climb to about $10 a share, and the CEO therefore enjoying a 900,000 share sell-off for a realization of about $10 million. We all want to be his friend. So when we're also looking at coal players here at Stock Specialists, we're recommending one company that you can jot down with your pen and paper. You can jot down Yancoal, YAL, Yellow Apple Lima. Marco is going to be touching on that a little bit later on as well, and he's going to be talking about pricing. He's going to be talking about exports there, particularly now with China coming out of their COVID zero policy and revamping their industry, which is going to be an important point there of conversation. And so therefore now we're starting to see kind of energy prices start to fall there a bit. So with inflation there, we've got 7.3% reached in October. Now here in Australia, we've got inflation there on the monthly basis there of October kind of fall. Now from there, the annualized rate of inflation starting to come down off the back of rising interest rates. In the US, we've got inflation peak at about 7.1%. Still high across the board is the point here. Regardless of the increased pace of interest rate climbs, we've got a lag effect, which we have to be realistic about. And this is going to take time to filter through the economy. We've got economic growth as a result of this contractionary policy implementation start to reflect where we are, which is a slowing economy there on a GDP basis. The global economy has been weakened by the war through significant disruptions in trade, fuel and food-based prices. I mentioned earlier we saw the price of wheat, agricultural-based products also climbed there out of as they were on the supply side there from Ukraine. We saw energy prices climb, grains, metals, signaling that inflation might continue accelerating. There's also news there on Russia amping up their war-based efforts there in Ukraine. So in terms of the uncertainty that we have ahead of us, this is something which is going to be playing well and truly, I think, at the forefront of policymakers' decision making moving forward. Yep. And then we've got there, off the back of rising energy prices, we saw the spike there in 22, the second highest spike there since the oil shock of the 70s. Now, I want to make it clear that supply chain disruptions were amplified. We had the Russia invasion of Ukraine. We also had China there completely, essentially shut down and block off access of their ports. It's only now they're starting to come up out of that. We also had the rising energy demand, into the winter there, into the European winter, North American winter, which saw energy prices climb. We saw Australian companies like Woodside leverage off of this. Marcus will touch on that a little bit later, which was well and truly accepted there by shareholders and in their share price. We also saw a low spare oil capacity there, and inventories fall, which led to the increase there in the energy prices. So 22 there in a nutshell. We had the war in Ukraine leading to energy pain on the price side. We had inflationary pressures accentuated by the sudden surge in oil, gas, and coal prices, which on the flip side reflected really well for Aussie-based companies there on the resources side of the equation. Unemployment has remained extremely low since about 1974. We've got it now at about that 3.5% odd. Wages also were rising, as we saw enterprise agreements there renegotiated there with the private sector. But it's nowhere enough there to keep up with the cost of living, particularly there with the cost of your servicing on your mortgages. We're all feeling that. And we have to budget accordingly. So the RBA there is lifting rates faster by more than it has in the last 30 years. And the economy is rapidly slowing. And we're seeing that. We've got rising inflation, falling GDP, and we've got low unemployment. So that is essentially a stagflationary context. There have been a lot of pundits talking about when the Fed's going to pivot and increase interest rates. Now, sorry, not increase rates, rather go the other way and reduce and cut interest rates. Now, we don't believe that's going to happen anytime soon. The reason why is because the unemployment rate hasn't moved yet to the upside, and there are significant upside risks there that we have to remain aware of. And this is going to play out over the next couple of years. It's not going to play out over the next couple of quarters. So our outlook, therefore, is going to be a pretty kind of stable move into 2023. It's not going to be that volatile kind of crash burn scenario that we saw there in 2020 off the back of COVID. Yep. So we've got there a nice geographical map there of who's been increasing rates, who's been cutting, who's been kind of stable there and haven't increased their rates. Our scenario there for 23 will be a year of inflections, where we've got market participants trying to identify turning points for inflation. And the expectation, therefore, of inflation cuts and inflationary declines is going to be a big one, especially for asset prices and asset-based revaluations, as we then get investors kind of thinking more about than interest rates. And I want to make it clear to the investors listening today that interest rates moving forward in terms of hikes, we're expecting the RBA to play out at about 25 basis points, no more at that 50, 75 that we had seen in the past. We're going to be having periods where where we're going to be having a bit of a reprieve from interest rate hikes. It's going to be somewhat of a sideways market in the sense for interest rate climbs. So, this is going to play out over 2023, 24, and, certainly into 2025. So kind of that midterm view and that horizon is something that investors are going to be pricing into their portfolios moving forward. And investors probably would be thinking about diversification. They'll be thinking about contrarian plays, gold in particular. Now, gold, if you wanted to jot these down on your pen and paper there, added to your watch list, we've been looking at the gold-based ETFs. A nice one there by Vanek Junior Gold Miners, GDXJ, kind of sitting at about that high 40s level there. We're also looking at the beta shares QAU, bullion-based ETF, kind of sitting at around that $16 level. So if you want a kind of broad-based exposure, either there to those bullion or those gold-based miners, those are a few there that you'd be able to pop into your list, aside from Northern Star or Evolution Mining, which we provide coverage on there, or provide coverage on here at Stock Specialist. We'll move on. So a couple of questions arise there. What could possibly prevent a market rebound there in 2023? We believe that an escalation in the Russian-Ukraine war would be cause for concern, which is what's playing out now, off the back of conscription there, which is what we're seeing in Russia, closing off the borders there for their youth. When it comes to them perhaps thinking about fleeing the country, that's not going to be the case. They're certainly ramping it up there. Policy missteps there in China, they could get, the Chinese could perhaps get it wrong. They could overshoot, they could undershoot. I mean, we have to wait to kind of see what they look at planning moving forward into 23. But let's keep in mind there, the Chinese economy, the GDP on a GDP basis is still multiples of times greater than the Australian economy. And although they may be slowing down on a GDP basis, they're still well and truly in the green. And so China, therefore, is a nice kind of contrarian play that we've been kind of exploring. And if you're looking for a nice kind of ETF kind of international diversification ideas, iShares have a pretty good ETF that you could pop onto your watch list there as IZZ, Indigo's Zebra, which is a nice China kind of large cap ETF, which you could probably take a look at. When will central banks cut rates? Interest rate expectations are what's kind of driving the RBA moving forward. There are, however, a lot of key uncertainties at play, which I mentioned earlier, particularly there, the Russia-Ukraine war, as well as also the rate of inflationary pressures. The expectation is inflation will start to ease into 2023, probably mid 2023 we'd start to see kind of these numbers play out a little bit more as we get the interest rate kind of curve really kind of put a hold on consumer spending and business investment here in Australia. So we'd start to see these pressures, these inflationary pressures kind of normalize, stabilize out. So by the end of the year or there for the Fed to start to consider rate cuts, as you can see there on the right hand side in the bolded green, and we're taking a look at the unemployment numbers. That's going to be part of the determining factor here moving forward. And we've got now underlying inflation at about 6.1%. RBA expects it to hit 6.5 before declining to about 3.8% there late 2023. That's the view that we have here in late 2023. Australia's rates are no longer at record lows, as we're all well and truly aware now. We cut by we increased by 25 basis points there in December. We were considering a 50 basis point rise, but they settled for 25. We're now at 3.1, and they cut it. RBA cut it by 20. Increased it by 25 because they had saw that on an annualized basis, inflation there on a core level started to soften, which is good news. But central banks are kind of talking about inflation continuing to climb. Is certainly a kind of a cause for concern. However, our view is that from the data which we're getting and observing, we're seeing household consumption now start to slow, moving into Q1, Q2 2023, and so we're going to see kind of savings rates continue to climb. And so this is going to be something that we'll be looking at, and we'll be providing coverage on moving forward. Tightening monetary policy, the energy crisis in Europe, ongoing COVID-19 scares, property market challenges in China will contribute to lower economic growth and earnings declines there into 2023. However, we remain optimistic, and we do believe that global growth should bounce back into the second half of the year, as we don't get kind of that increased those increased interest rate hikes on a monthly basis, which we've been kind of seeing over the last kind of 8-9 months now. That's going to certainly slow down and give us some break periods there in between. So recession to then growth. We've got some of the merchant banks out there, some of the larger fund managers talking about their ASX 200 kind of pricing targets. AMP, they're on the higher end of 7,600. Credit Suisse, they're on the lower end of 6,700. And these are their kind of year-end pricing targets. These will change, certainly change very much regularly. Where Stock Specialists sit, Stock Specialists is kind of sitting at about that 72, 7,300 level there by year-end. We've got higher interest rates really kind of taking a stranglehold on the economy, reflecting through to business investment, to domestic consumption. We'll start to see that slow down, you know, from that kind of 3.5 there to about that 2.8% is kind of our expectation there for GDP. We expect 4% earnings contraction in the US, 10% decline in Europe, 2% growth in Asia there in 2023. Kind of, you know, conservative kind of figures. We on a positive note are projecting kind of Australia's growth of about that 4%, slightly lower than the long-term 5.5 growth rate there, you know, and that could certainly kind of, that 4% there is based off of the data that we've kind of accumulated, is an estimation, but we certainly kind of expect it to perhaps be just a little bit lower than that, which we'll be talking about. Marco there will be touching on a little bit further. We expect global growth to return a bounce in that 2023 kind of year-end period, and growth forecasts improving as we begin to kind of look into that 2024 as interest rates start to normalize. Members, we are having a bit of a special when it comes to Stock Specialists. On the Diamond membership, we are offering assistance with that portfolio construction, portfolio reviews, to be able to kind of talk about sector rebalancing, to be able to kind of give you fresh and new ideas about, you know, what to take a look into, you know, where's the kind of the potential growth to come moving forward. Are you looking at gold? Are you looking at yield? Stocks and sectors, stocks within sectors paying north of about that 3.5-4%, fully franked dividend profiles. We can help you out with those. Mining stocks in terms of the resources plays off the back of a declining, off the back of kind of still of a low kind of US Aussie dollar relative to the USD. Which is great for the export side on the natural resources plays, particularly iron ore and coal and gas, for example. We give you also that account manager, dedicated account manager, so that you can call in and deal with one person to talk about your portfolio, which you can send in there for a nice review every month or every quarter. And there you can see that the Diamond package usually retails at about $3,000. We've cut that to about $2,000 per annum, and we also have a multi-year bundle there for about $3,997 for a 3-year membership, not at $3,000 per year, because we want investors to get involved and get ahead of the game rather than continue to perhaps slip behind if you are already.
Fantastic. Thanks for that, Mark. So there was a lot there. I think for me, the main thing, of course, is, you know, despite the sort of macroeconomic headwinds that are going on, there is still definitely a lot of sectors, especially particularly the Australian market, that you know, investors can definitely take advantage of going forward. So, you know, looking forward, as was previously mentioned, but on more of a micro scale here, we have identified 3 primary catalysts that are likely to have a dramatic sort of effect in 2023. And as Mark mentioned, it's that particularly that China's return to a larger growth aspect and a larger growth profile. A lot of inconsistency so far, especially in their export and imports terms of trade. Primarily a lot coming through from the Australian coal market in particular, and political headwinds as well. The Australian government's having a few concerns when actually importing and exporting coal to China, and actually ratifying a lot of price caps on them as well. So the Australian interest rates, of course, still have a little bit further to go. The big four tend to put their primary predictions forward. We're expecting somewhere north, somewhere closer to the ANZ and Westpac predictions, about that 3.85, 3.9%. Particularly for the main reason for that is a lot of the primary inflation was caused by that housing market debacle, and going forward, a lot of those other factors, particularly food, fuel, and commodity-driven inflation targets, will see some further increases going into the next few months. And of course, the economic growth predicted in Australia, we're expecting that to go from about 3% last year to about 1.5%, which will of course be buoyed primarily by the commodities and resources sectors, but will be having a bit of a dampening effect from the housing market that we mentioned there. So looking forward, of course, seems pretty obvious when you take a look at it, but you can see those total returns from particularly the technology sectors and the consumer discretionary sectors. We are taking a bit of a step back away from those. And of course, the primary reason for that is the higher inherent risk that a lot of these companies are having, particularly in the consumer discretionary space. You've seen companies with the likes of Harvey Norman, sort of Domain Holdings, all these sectors and stocks that focus particularly when customers have a bit more disposable income on their belts. Of course, with that, coupled with lower margins and increasing costs for these sectors, a lot of these companies have been really faltering. So avoid those. And technology, of course, being the primary loser last year. That's outside of communications, of course, but the 30% loss almost, and a lot of these bigger companies with the inherent higher risk, you've got companies like your Zips and your Sezzles that have fallen about 90-odd%. Those are the things, of course, we want to avoid, especially things that we're not going to be recommending that have that inherent risk. However, in saying that, there are still a lot of companies in both of these sectors that still remain quite resilient. Even in the technology sector, you can have a look at a couple. One that we're looking at in the actually software trading space, which essentially has a semi-monopoly on the Australian consumer use basis, having customers with the likes of Goldman Sachs and CMC and all those big players there. Is a company called Iris Limited, IRE. We have about a 13 target price over the next 12 to 18 months. And the reason for that is a lot of these companies have still maintained good, strong balance sheets and low debt. Of course, we've still made, I think, one of our best stocks for last year was Computershare, which is a technology stock, and that did about 100% for our members last year. So we're pretty happy with a couple of those, but you won't be seeing a large amount of technology recommendations coming out of us. So, given all of this that we've had a quick look at, in terms of the macroeconomic environment and what sectors to avoid, there are, of course, as I mentioned, still a lot of positive yielding assets to take a look at. We've focused primarily on these four, which are defensive assets, gold and critical minerals, which of course will include your lithiums and your rare earths as well, your consumer staples, your income yielding stocks, which of course a lot of our members have thoroughly enjoyed finding a good income yielding stock. So I'll go through these one by one. Taking a look at your gold and your critical metals, your critical minerals, I should say. As you can see, the gold price for the year hasn't really done much, but you can see that inflection point back in November, approximately last year, a few months ago. We put back on a high conviction buy a lot of those big name stocks that people have been avoiding for quite some time. Companies like your Evolution that sort of dropped down to about $2.60, back up to about $3.60. And one of our primary recommendations, which Mark mentioned, was Northern Star. It bottomed out at about approximately $7 odd, and is back up now to about $12 in the space of about 3 months. So we're really happy with some of the results that we've seen so far, but we are still looking forward. Still see plenty of upside, especially when we're focusing more on these defensive assets there. And another ETF as well that you can take pop a quick on your watch list is also PM Gold, which is the primary difference between QAU and PM Gold is that the QAU is currency hedged, so to the US dollar. So really dependent on, of course, what your currency expectations are. But that's also another great ETF. Both of those ETFs are also very low cost. I believe they're in the range of about 0.3% fee per year, which is really great. So just on the next one here, focusing on a few defensive assets. You can take a look at the global healthcare ETF. That's outperformed the ASX 200 quite considerably over the last 5 years. You can see that there. A lot of these healthcare stocks have also come under the pump, of course, post I guess, well, some would consider the COVID pandemic now to be officially sort of over. So we're seeing a couple of headwinds coming out of the sector there. But a lot of these healthcare stocks have come now really under some really great valuations, trading in low PEs and high return on equity. So a particular one you can take a look at now, which we've been covering for quite some time, which fell a little bit off the back of the failed sort of KKR takeover. That was a bit of failed due diligence on the takeover partner's part, but that would be Ramsay Healthcare, RHC. We're going to be taking a really close eye on that one there going into the year, and looking for a good buy price for our customers. But of course, we'll be looking at that quite considerably. But of course, you have to be a member to get that sort of inside detail. But so the next one, of course, is consumer staples. As the name suggests, it's the opposite of your consumer discretionaries. It means regardless of the disposable income that consumers have, they'll be obviously having to pay for it. So you're taking a look, particularly at, say, your groceries. I wouldn't be focusing too much on your Woolies and Coles. And a great one that we recommended and we've provided coverage over for the last couple of years would be Metcash Limited, the owner and wholesaler for the IGA and Foodworks divisions that here in Australia. They've done really well. It goes without saying. I think we've received about almost 100% return on that particular stock over the last sort of 18 months. And it has about a 6% dividend yield, which is also fully franked. That's a great one that we've been keeping an eye on for quite some time. And our target prices, of course, change based on the macroeconomic context, but we do expect it to do quite well going into this year. And of course, taking a look at the resources sector in particular, you're focusing on your Woodsides. We have a target price of about $44 for Woodside, based on that redirection of a lot of their exports going from the Asian market to the Western European and North American markets, taking full advantage of the northern hemisphere winter coming forward. Produced about 5.8 million barrels in the last September quarter. Got them a huge amount of revenue with also low cost. That's the primary identifier for us. That separates them from a lot of these oil and gas producers outside of Woodside. That, of course, came after the BHP merger. So their cost per barrel is approximately in the range of about $10 per barrel. And with the oil price currently sitting about 85, that's pretty intense margins. So taking a look at companies like that are the ones that we're focusing on quite strongly. Oh, and also you can see there, if you wanted to get exposure to particular consumer staples, you can take a look at that IXI ETF, which also has considerably, and you can see there the main well, a great indication is just on that chart there. You'll notice, despite the ASX 200 plummeting about 30–40% during that initial pandemic, you can see that consumer staples ETF actually was quite resilient. It only fell about 10%. So those are the assets that you want to be invested in going into a more tumultuous and, I guess, more uncertain year. And the final one here are, of course, your income yielding stocks. So the first one, and I think probably one of the best ETFs if you want to take strong exposure, there's the Vanguard Shares High Yield ETF, it's VHY. That has, I think, currently about a 5.5% yield, but I do believe that is subject to increase, of course. That the only reason that annual yield has come down a little bit is because, of course, the prices of a lot of the stocks in the ETF have actually gone up. but the primary focus for this ETF is to focus on high yielding stocks. So you're looking at particularly companies like your Fortescue Metals, your Woodside Energies, your BHPs, that's given current resources and given the current strength in the sector itself, providing about 8, 9, 10% dividend yields, which are also fully franked. And of course, as Mark mentioned previously, it's not in this ETF, but a lot of our income stocks that we provide are also not just in our income portfolio, they're in our mining portfolio. And Yancoal is that one, which is looking to provide fully franked dividends as opposed to unfranked yields last year, but a dividend yield upwards of about 18% based on the current coal prices and the margins that they're receiving. As I said, similar to that Woodside thematic, they're providing a lot of their, obviously 100% exporting. They're not maintaining any of the coal in current Australian customers. The main reason for that, of course, is there's price caps for that. But they're taking full advantage of the demand, international demand. And another great thing is they're not fully exposed to any potential downside in the Chinese market, which are lots of companies such as New Hope and Whitehaven. You can notice there that they've actually had a bit more downside in the last few months than Yancoal has. So, I think about 30%, 40% odd of their exports are going to Europe, and 20% is going to Japan, which is a very, very high energy demand country and economy, especially after I believe 75% of their electrical requirements were previously coming from Russia. So they've been obviously having to fill that void. So overall, still a lot of tailwinds that we can see coming, especially out of the Australian resources and defensive asset sectors. But of course, it's all about timing. We're always taking advantage and looking at researching and processing a lot of the information that's coming out of various sources to update our target prices. And this can always be subject to change. But so far, we actually had a pretty great year last year, despite all the volatility, and we're looking to obviously eventuate that even more this year. So thanks for that, everyone. Yeah, I'll pass on to Mark if you've got any last final words.
Fantastic, investors. Thank you so much. Yep. So what we've got here is the gold, the diamond, and a multi-year membership there for investors to consider. Yeah. If you have any questions at all, what we'll do is just have the phone lines open there where you'd be able to give us a call, speak to one of our equity specialists about anything that we've discussed throughout this webinar. Also speak to Mark, our portfolio manager, about any stocks there that you may have questions about that we may be able to assist you with. A big differentiating part of our service here is that you're able to give us a call, you're able to speak to market-based experts with their fingers on the pulse of the market, and you're not charged for it. You're able to have a friendly discussion there about your portfolio, about stocks, about ideas that you may have, about sectors which you may be considering taking a deep dive into. And then we'd then be able to kind of assist you there, particularly with now kind of the rhetoric kind of changing and moving away from growth more now into yielding stocks, dividends there, which are really important kind of moving forward, particularly out of the mining resources play. Like companies like Pilbara there, PLS looking at paying there a dividend, which Marco touched on. So that's all really, really good. So we look to a fantastic 2023 year ahead, and we look forward to being in touch with you all shortly. Have a great day.